Everyone, welcome to the Income Masters channel. It is September 3rd, 12:30 p.m. Eastern. Here with Dave Durham, and my name's Emily Norris with Traders Reserve. We're going to do today's session in two parts, starting with our deep dive into tactics, the educational portion. We'll record that separately and post it to the Income Masters courses. And then we'll also be doing a regular session with some trade follow-up. We are recording these sessions. We'll post replays to the platform. If you have any questions, you can pop those in the chat box. And if we send out any trades, we'll send them out via push notification and email, and also post them to the announcement section below. With that, I'll let you take it away, Dave.
All right. Thank you, Emily. Welcome back. This is a regular Wednesday deeper dive into trade tactics. Today, I'll call it a short session on price action in stocks. Some of this will be very familiar to many of you. Some of this may be just a reminder and helpful when you're looking at the prices day to day in our stock positions or stocks in your own portfolio. So that's why I wanted to kind of pull this out, and because I've gotten different questions sometimes, and I think it'll help a little bit with how we use this. So basically, price action is a real-time reflection of supply and demand in the market. And basically, there's buyers and sellers. We are aware of that. We're not the only ones trading, and we're not the only ones buying and selling stocks. There's lots of that out there, and that tends to be a big part of this. So it's a movement of price action. It's a movement of stocks price over time. Traders, particularly short-term traders, like to analyze it without heavy reliance on indicators unless they go out longer term. But it really, reflects that supply and demand of stock, and whether people are selling and buying any time during the day. And we've seen this clearly in many of the trades that we do and how that impacts it. At a high level, what drives price action? Well, it's a buyer-seller's tug of war that sets prices, and that comes from everything. It could be news and events like earnings, Fed decisions, economic data. It could be market sentiment, fear and greed, herd behavior. Also, liquidity and volume, how easily shares change hands on different stocks can also move price action. Less liquid stocks can have a more volatile price action with them, and more liquid stocks tend to move in more consistent directions. Now, if we get into the specific causes of price actions, we probably are familiar with most of these. Earnings clearly is the big one. We're all aware what an earnings report does, whether it's positive, negative, or just even the guidance is off. Interim earnings adjustments, which come in by the company ahead of the earnings or be after an earnings about something they've seen. They want to get a heads up to the analysts world that they see a change in their adjustments. You go to analyst upgrades and downgrades. They can move a stock a little bit in one day, and unless there's a lot of them at once on a particular stock, either up or down, it tends to be a one-day phenomena or even a couple-hour phenomena. Economic data, we've talked a lot about that over the last year. Payroll reports, jobs reports, the CPI, PPI reports. A lot of economic data can move stock prices. Regulatory issues, particularly when it comes to dealing with overseas governments, and some of the big Mag 7 stocks are always up against some kind of regulatory judgment. There's legal issues too, and lawsuits and judgments against companies that can move a stock. We've seen this year plenty presidential policy, i.e. tariffs and tariff potential, tariff threats, and just the tariff in general war that's been going on is definitely a mover of individual stocks. Executives, that's CEOs quit, chairman of boards quit, somebody gets fired. The CFO leaves, that can actually hinder a stock, or maybe the right hire of a CEO or a CFO might lift the stock. Mergers and acquisitions also have an impact on stocks and stock prices. Typically, on an announced acquisition, the buyer's stock price goes down. On the acquiree is the stock price that goes up. You have what you call sympathy trades. You may have a stock reports bad earnings, and in the same sector, let's say it's in the retail sector, another retail company or a bunch of them might sell off that day because of the earnings report of one company. But liquidity in stock is also a big deal too, because it's not just in the options we trade, but there may be stocks that just are not as liquid. So when they get a lot of buying and selling, can move the stock price. Government contracts awarded or lost for those companies that deal with the government, both U.S. and foreign governments. You also have recalls on consumer products. And when you get to commodity prices in the oil and natural resource area, you have geopolitical issues can also impact that. And you can go on and on. There's plenty of specific cause prices we're generally aware of when we come out. And then some days it's just the market melts up and the market melts down. Um, we had that recently, Friday the 22nd, after Powell spoke in Jackson Hole. And said, I think inflation's coming, is still flat, but the jobs, we're concerned about the jobs numbers, and we can see a rate cut coming here soon, which means September. And the market jumped up that day. That was the week of income madness, where we had pretty much every day traded lower, and then we had the melt up on Friday. Well, then it wasn't that much longer, a week ago, August 29th, when the market melted down, where we had basically, or maybe not meltdown, but certainly sold off hard and kind of hit all stocks, regardless of what the stocks were doing. So we're all aware of that. That's the hoard greed mentality and the fear mentality that in play there. But this is probably the bigger point I wanted to make with price actions. There are days when the market is trading flat, market is trading slightly up, the market is trading down, or it's bouncing around, where the stock you're trading or you own is down today. And that's mainly there's more sellers than buyers that day. There's no reason. There's no news event. This is part of the daily transaction of the stock market. Or your stock is up and it's great. It feels good if you're in a bullish position or neutral to bullish position. That's because there's more buyers than sellers. So sometimes there's not an explanation for a stock price movement on a given day. And that's why we really don't focus too much on it, or I don't focus too much on that, because can't really do anything about it. And we're not in the kind of game where we're trying to play day trading and one day investing or trading. Yeah, it does impact us when we get into something like income madness, but even then, we are not trying to trade intraday or one day moves. So again, just keep that in mind. There's just some days you're going to have more sellers than buyers on the stock you may own or you may be trading. And other days you get more buyers than sellers and the stock moves up. Daily patterns and price action. And this is a big overview. It's not literal, but it is generally what you see on a day-to-day basis, or at least intraday basis. The opening, which is definitely that 9:30 to 10 a.m. or 10:15, can be very volatile. And there's overnight orders coming in, overnight news being digested. Sometimes it's earnings reports. Sometimes it's the government or the economic reports that come out at 8:30. But that volatility period is a reason why we don't really initiate new trades between 9:30 and 10. In fact, I really prefer not to wait to do anything until about 10:15, 10:30. It is a time, possibly though, to take profits, particularly if the market moves in our favor and one of our positions, whether it's down or up, is getting close to its target exit price and we get filled. We do get a lot of fills between 9:40 and 10 o'clock when we're exiting positions. So that period is volatile, but that's a reason why we don't do, for example, somebody asked a couple of months ago, why don't we just start trading at 9:30, 9:45 and hold our session early? Again, that's the reason. This goes back to many traders don't like to trade in that 9:30 hour unless you're trading very short term or swing trading. And that's why we don't even adjust positions during that time frame. We need kind of that more steady trading flow that comes after 10 o'clock in the morning. That's not maybe the case every time, but it's generally a rule you see there. Then roughly midday, that 12 to 1 p.m. is when we get kind of the midday lull. You get lower volume, smaller moves on stocks. Again, it's not always the case, but it's generally what you see day after day. And that one reason we hold sessions either at 12 or 12:30, because it tends to be a time when we can get our trades on, get them set up and trade, and hopefully not have it being moving too fast or too fast up or too fast down. And then you get more action in the afternoon, but then get this again, sort of a closing surge. It could be institutions adjusting their positions, rebalancing. Sometimes the end of the day is a market trades up. That's what happened yesterday. But sometimes it's also trades lower. It gets again becomes particularly a little more volatile. But we've seen a number of times where we have had some of our positions fill at the end of the day. We don't get an alert out because basically they're filling at 3:55, 4 o'clock, and it's the next day we kind of realize, okay, we hit that target price. So again, this is generally price action volatility throughout the day. I think if most of us who are trading long enough know that recognize these kind of trends and know that sometimes it changes and sometimes it doesn't. So one example day, here's a stock that rallied off its earnings here on this chart, jumped up and then pulled back, hit resistance and sort of a midday pullback, and then went into the close trading higher. So basically, that's a phenomenon sometimes you see with stocks that have positive earnings reports. They get that initial bump, get a bit of a pullback, and then can sometimes trade into the close higher. Again, not every trade and not every stock does that, but there's enough of that we've all seen that happen a number of times with our positions. Where price action, though, does come into effect and where traders, and a lot of times we use that, is in technical levels in price action. That's support resistance, looking where buyers are defending their price zones or sellers are defending their price zones. We look at that from time to time. It is not primarily the way we trade in income masters. We tend to be more math and probability oriented for generating income. But we do look at the trends where the stock is going. We use an indicator that helps us. Does it always, is it 100% guarantee? No. Sometimes it's very helpful. Sometimes it's just a signal that keeps moving and changing around. So we get breakouts and breakdowns, and then there's trend lines and channels, and we'll get into a little bit. We'll dig into a little more of this into September and another deeper dive tactic session later in the month, and we can look at a little bit of price action. How do we use this to help our positions set up better? And in effect, it does impact sometimes decisions to use a underlying stock or ETF when we see a chart that looks like it's heading in the wrong direction, either up or down. And same thing with candlestick patterns. There's lots of different trend lines, technical analysis that you can get off your Thinkorswim platform that does evolve around price action. So we'll dig into a little bit of that later in the month of September. Why this matters to traders? Well, obviously it helps identify entry and exit points. That's somewhat what we try to use them for. It can show strength or weakness of the moves that the stock is making at the time. It can confirm or contradict indicators. Again, no indicator is 100% right all the time. But it's really price action in technical trading is really valuable for short-term scalpers or swing traders who are making 1, 2, 3 day trades, going in and out very quickly of stocks, and maybe whether they're using options or you're just trading the stock itself. They use this on a lot of short-term basis. Again, because we use the math and probability approach, whether when we're doing a put or call spread, we're usually setting up a longer days to expiration, 30 to 50 days. We talk about this. We got to have option liquidity when we set this up as a group. We would like to get deltas as low as possible. We try to be in that 15 to 22 range. Our goal is to collect 1/3 of the width of the credit. That rarely happens in this kind of low volatility environment. Without taking a lot of extra risk, and then close these trades at about 45 to 55% of max profit. Try to manage early if the stock moves against us, if we have in that 18, 22 days range, whether we can roll down, roll out. So again, we're price action does impact our daily, our positions. But one day's price action is, if we set these trades up right, we're going to expect stocks that go up and down. We don't expect our stocks to go straight up. When they do, it's great. We get out real early because we hit our target exit price within a couple days. That has happened a number of times. That's unexpected but welcome. But again, most of the time we're going to go down, closer to the 21-day, 22-day mark with that. So key takeaways, price action is basically pure supply and demand. We just got to remember that there's buyers and sellers in the market, and they're going to make determinations along with us as we're buying and selling. We have the day-to-day moves, obviously shaped by news, sentiment, different economic reports, etc. But understanding it, it helps to understand when a stock is moving up and down that if we're trading in our way, we don't have to react to it right away. And again, price is truth. Price action is real. So it's still something we pay very close attention to. If a stock continues to trade lower or trade higher against our position, we're going to take action with that because of the price action there. So that's a overview of price action. We'll dig into a little bit on the technical side again later in September here. And with that, I'll take any questions. Otherwise, we can flip over to just a quick review of some things for the session here today.
Dave, can you speak to how short interest plays into this?
Well, short interest, yeah. I mean, short interest can be tracked along. Certainly, and stocks that basically have big institutions that are making bets against them. And we can all think of, well, one of the most obvious ones, a lot of short action has been Tesla. Tesla was a favorite of short selling, and for a number of reasons, the grandiose plans of Elon Musk and everything that Tesla stood for and became, but was getting into the launch business, but also the fact that there's just a lot of news and rumors on that. So that's a classic sort of big stock trade. But you saw the meme stocks where short action, is you had long action for up to the upside, and then mainly the shorts jump back in. You have other things. I remember working with some institutions and financial institutions that actually were hedge and institutional funds who played short positions totally, and they would generally. One of the areas they used to pick on a lot was the biotech area, where you're developing new drugs, and these are small companies that are basically making big bets on breakthrough drug research and testing and rollout. And a lot of times, big institutions are looking for what they can find that says basically this stock has got problems with this drug trial. It's not going to get to the level that it claims it is. And so they start betting big time on short interest. So that will move the price, even if the company is actually a pretty good company and actually making some good headways in that area. But that was anytime you get into biotech, you can get a lot of short interest on these smaller to medium sized companies. Probably not as much on the big pharma side. Another company that got a lot of short interest, and it's not surprising if you've traded it, is originally it was Intel, who in the last year or two really has been, because of just a lot of things, leadership, lack of vision, trying to keep up with all the emerging companies coming into the semiconductor space. Intel had a huge amount of short interest, which made it, even when it had good news to report, made the stock a lot of pressure, more sellers than buyers, in fact, even if you had a positive earnings report. And Intel really took the brunt on that. And particularly as it traded down to a $30 stock and down to the 20s, there was always a lot of short interest layered up on it. You can go out and look at stocks. You can actually sort on Thinkorswim and scan for stocks that have a lot of short interest on them. They generally tend to be smaller to medium companies. I guess a lot of them could be in the Russell 2000 space. New tech companies that are still unprofitable and that have made big news and trying to wave a big flag also get a lot of attention from short interest. Definitely when I uncover a company that is potential for us to trade, it's one of the first places I go to look at short interest on a stock and see how much is there and how that has flowed. And again, you can use Thinkorswim. There's a number of places you can go get short interest, but Thinkorswim has that also as well.
Okay, Dave, that's the only question about this presentation.
All right, I'll stop this and we'll go just do an update here for the week.